You know, we throw the word success around all the time, but what does it actually mean when we're talking about our money? Is it just a feeling you get, or is it something real, something you can actually measure? Well, today we're going to break that down. We're going to define financial success, not as some vague idea, but as a set of cold, hard, concrete numbers.
So let's start with that big question. What is success? We all have our own personal answer, right? But in the world of finance, the answer isn't personal at all. It's professional. And honestly, understanding that one little difference is the very first step to actually achieving it.
And here's where it really splits. See, in life, success can be personal, emotional, totally subjective. But in finance, that's just not going to cut it. Success has to be concrete. It has to be measurable. And it's driven by objective metrics. You can't just feel successful with your money. You've got to be able to prove it with data.
Which brings us right to our first major topic, measuring success. Because look, there's that old saying, right? If you can't measure it, you can't manage it. And you for sure can't improve it.
It turns out financial success isn't just one big number in your bank account. It's more like a balanced equation, a whole system that we can break down into 5 distinct but totally interconnected key parameters. And understanding these is the real first step toward building an actual strategy. So let's open up the toolkit. Let's look at the 5 measures of success that the pros use to evaluate pretty much any financial strategy out there.
Think of these 5 things like building blocks. They all stack on top of each other. We start with capital growth. That's how fast your money is actually multiplying. Then we have to protect it with risk control. After that, we make sure we're never actually going backwards with capital preservation. Then we build reliable income streams with cash flow stability. And finally, we get to the ultimate goal, time leverage. That's where your money is truly working for you.
All right, first up, capital growth. Now, amateurs, they might look at the total return, turning 10 grand into 20 grand and getting all excited. But the professionals, they look at CAGR. That's the compound annual growth rate. It measures how consistently you perform year after year, which is a much, much truer sign of skill. So what's a good number to aim for? Well, a long-term CAGR of 12% or more, that's widely considered the success zone. And we're not talking about one good year here. This is about sustained, powerful growth over a long period of time. And just to put that 12% into perspective, the S&P 500 historically returns about 10% a year. So if your strategy can consistently beat that market average, you're generating what the pros call alpha. And that means you're not just riding the market's wave, you're actually outperforming it through skill. But listen, high returns mean absolutely nothing if they come with terrifying drops along the way. And that's where risk control comes in. A portfolio that goes up 15%, but then has these 40% drops, isn't a success, it's a roller coaster. And who wants that? True success is getting those strong returns while keeping that volatility and your potential losses firmly in check. And really, who better to explain the next parameter than the man himself, Warren Buffett? His 2 famous rules bring us to the absolute bedrock of building wealth. See, Buffett's rule isn't just about making sure your account balance doesn't go down. It's about beating the silent killer of wealth, inflation. I mean, if inflation is eating up 6% of your money's value, but your investments only make 5%, you're actually going backwards. True capital preservation means your real return, after you account for inflation, is always positive. Okay, now let's build on that foundation with our 4th parameter, cash flow stability. This is the fun part. This is where your assets actually start paying you. We're talking about creating multiple, stable streams of income from things like stock dividends, rental properties, business profits. This is the engine that will power your financial independence. And all of that leaves us right to the highest level, the 5th and final parameter, time leverage. This is the magic of compounding in its purest form. It's when your money is invested in systems that just grow automatically, year after year, freeing up your time to do, well, whatever you want. At this point, your money is officially doing the heavy lifting, not you. All right, so now that we have the tools, let's see how they help us climb the ladder. It turns out there are 3 pretty distinct levels of financial success that all of these parameters help us reach. So, these 3 levels really map out the journey. Level 1 is survival. That's just where your income covers your expenses. Level 2 is stability. This is where you're using capital growth and risk control to actively save and invest. And the summit, the gold medal, is freedom. This is where your cash flow is so strong that your passive income from your assets covers all your living expenses. At that point, my friend, you have achieved true time leverage.
So after looking at all these parameters and all these levels, what is the true formula for success? Let's try and distill everything we've just talked about into one clear final picture. First, let's just be crystal clear about what success isn't. It's not about having a giant sum of money in your bank from some lucky one-time win. It's not a speculative crypto spike. What it is compounded growth. It's controlled risk, and it's the discipline to execute a solid strategy over a long, long time. It's a process, not a prize.
So here it is, the true definition. Financial success is the sustainable, risk-adjusted growth of capital that outpaces inflation over the long term, all done through a structured strategy. See, it's not about getting rich quick, it's about getting wealthy smart. So the next time you think about success, don't just ask how much, ask yourself, how durable is my strategy to get there and to stay there?